Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to take a close look at SoftBank's Vision Fund and explore whether it has been an effective capital allocator. This fund has been a major player in the investment world, known for backing a wide range of technology companies, but questions remain about how well it has performed overall. We'll examine the fund's strategy, key investments, and the returns it has generated to better understand its impact and whether it meets expectations in terms of value creation. Let's dive in and unpack the details. When SoftBank's Vision Fund launched with over $100 billion to invest, it seemed destined to reshape technology sectors and set new standards for large-scale investing. Early successes built a strong reputation, but the story has since become more complicated. The fund has faced significant losses, including a reported 115 billion yen loss in fiscal 2025, a sharp contrast to previous profits. High-profile setbacks like the troubles with WeWork and continuous portfolio value declines amid tech market volatility have shifted the perception from hopeful leader to a key example of capital allocation challenges. This mix of early promise and recent difficulties makes it critical to take a closer look at how well the Vision Fund has actually performed and whether it has met expectations as one of the world's largest technology investment funds. This analysis will closely examine how the Vision Fund allocates its capital and how well it executes that strategy. We will look at its performance by reviewing the gains, losses, write-downs, and any signs of recovery in its portfolio. To give concrete examples, we'll explore some key investments, both the big wins and the setbacks, and what these outcomes mean. From there, we want to draw lessons that can help in understanding large-scale venture-style investing. Finally, we'll assess whether the Vision Fund should be considered an underperformer in capital allocation based on the most recent fiscal data. SoftBank's Vision Fund set out with an ambitious goal to back transformative technologies on a global scale with unmatched investment power. Starting in 2017, it was launched with around $100 billion in committed capital, making it by far the largest venture capital fund at that time. The strategy focused on two main pillars. First, it aimed to make large late-stage investments, sometimes ranging from $100 million to several billion dollars. This approach was designed to beat competitors by enabling rapid growth and scaling of portfolio companies, though it also meant taking on greater risk. Second, the fund concentrated its investments in high-growth technology sectors such as artificial intelligence, mobility, robotics, fintech, logistics, and consumer platforms. Some of its most significant holdings included companies like Didi Chuxing, Arm, WeWork, AutoStore, and Coupang, reflecting a diverse but focused bet on sectors expected to shape the future. This ambitious scale and focus defined the fund's attempt to shape the next wave of technological innovation globally. Many of the Vision Fund's early investments leaned heavily on private market valuations that kept rising, creating a momentum that boosted paper gains. Unfortunately, when these companies moved toward public markets, valuation corrections exposed significant gaps between private and public assessments, particularly between 2019 and 2021. This valuation discrepancy became a recurring challenge, contributing to a less stable performance picture. In response, Vision Fund 2, launched in 2019, aimed to be more cautious and selective with its investments. Despite this strategic pivot, it still faced substantial losses, including a notable $3.6 billion write-down in 2025, mainly tied to markdowns of earlier stage startups. This shows the inherent risks and volatility of investing in emerging technology companies, even with a more conservative approach. Coupang stood out by consistently delivering strong performance through multiple reporting periods, helping to boost profits in Vision Fund 1 as its valuation recovered. ByteDance experienced nearly 30% revenue growth year over year in 2025, significantly benefiting Vision Fund, won through substantial valuation gains. Meanwhile, Grab and India's Swiggy played important roles in driving a $4.8 billion increase in Vision Fund's valuation during SoftBank's August 2025 quarter. Lastly, Arm Holdings, SoftBank's semiconductor design subsidiary, provided stability to the group's overall results and contributed positively to broader returns. Highlight some of the success stories within the portfolio that helped offset challenges elsewhere. WeWork stands out as the most well-known setback within the Vision Fund, experiencing massive write-downs issues with corporate governance that undermined both investor confidence and the fund's reputation, especially after its failed IPO. Similarly, DD Chuxing and AutoStore faced significant challenges as regulatory changes and market volatility led to sharp declines in their valuations, with AutoStore notably contributing to ongoing losses for the Vision Fund in 2024 and 2025. On the other hand, Ola Electric and Swiggy, both part of Vision Fund 2, encountered valuation pressures as well, with Swiggy's value suffering before its eventual post-IPO surge, while Ola Electric saw similar downturns. Lastly, the collapse of Greensill Capital in 2021 also left a lasting impact on Vision Fund 2, damaging its reputation further and inviting additional regulatory scrutiny. These examples highlight the risks and volatility that have shaped some of the fund's investment outcomes. In fiscal year 2025, the Vision Fund experienced a significant pre-tax loss of 115.02 billion yens, a stark contrast to the previous year's profit of 128.2 billion yens. When looking at the combined performance of Vision Fund 1 and 2 up to fiscal year 2023, cumulative investment losses reached $1.4 billion. Even though there were occasional quarterly gains, these were often negated by subsequent declines, showing a pattern of volatility. The portfolio also underwent substantial markdowns, particularly in companies like AutoStore and several late-stage startups, which contributed to a sharp drop in overall portfolio value. Vision Fund 2 alone reported a $3.6 billion loss in 2025, underscoring the significant risks associated with investing in early-stage businesses. These results reflect the challenges faced in maintaining valuation levels amid shifting market conditions and highlight the ongoing financial pressures within the Vision Fund's portfolio. SoftBank's investment division is highly sensitive to changes in the broader market, which is evident as SoftBank stock tends to drop by about 17% during times of market volatility. Despite these challenges, there are sometimes positive developments worth noting. For example, in the first quarter of fiscal year 2025, the Vision Fund saw its best value increase since 2021, gaining $4.8 billion. Additionally, SoftBank's overall group profit improved, returning to 1.15 trillion yens that year, supported by mature holdings in the first Vision Fund, even though the Vision Fund as a whole continued to face losses. This shows that while volatility and setbacks affect the portfolio, there are still signs of recovery and strength in certain areas. One key lesson is that deploying massive amounts of capital at late-stage valuations can create distortions in the market. This approach encouraged companies to grow without discipline, raised expectations unrealistically, and led to inefficiencies that ultimately resulted in well-publicized collapses. Another important takeaway is the danger of relying on private valuations without realizing exits. For example, some of VF1's private gains disappeared once those companies went public, showing clear mismatches in pricing. The volatility seen in the Vision Fund highlights the risks tied to soft or unrealized valuations. Lastly, focusing investments heavily in high-risk sectors like AI, mobility, and logistics, while offering great transformative potential, also amplifies the chance of losses. VF2's strategy of targeting early-stage companies in these sectors increased exposure to downside risks, making its outcomes more volatile. These lessons underscore the importance of valuation discipline, exit strategies, and balanced sector diversification. Governance plays a critical role in the success or failure of investments, as seen in the cases of WeWork and Greensill. where poor governance led to massive losses regardless of the amount of capital involved. This shows that strong oversight and management structures are essential to preserve value. Additionally, while strategic shifts, like the recent focus on AI with significant follow-on investments in OpenAI and large-scale projects such as Stargate, demonstrate ambition and adaptability, these moves alone have not yet translated into improved financial results. It highlights that while pivoting strategy is necessary, it is not enough on its own without effective execution and underlying fundamentals supporting growth. The evidence over multiple fiscal cycles clearly shows that the Vision Fund has underperformed in allocating capital, especially considering the vast resources it has deployed and the high expectations set at its launch. The fund presents a paradox, a bold and visionary strategy marked by some impressive successes, but also frequent and costly missteps. It manages massive capital, but struggles with inconsistent returns. And while there are moments of great insight, these are often overshadowed by ongoing volatility. However, SoftBank's recent strategic moves toward focusing on AI, infrastructure, and more disciplined investment practices suggest there is potential for change. If future versions of the Vision Fund, like VF2, combine long-term tech bets with stronger governance and more rigorous valuation standards, the fund might yet fulfill its initial promise. For now, though, the performance so far makes it clear that having extraordinary capital alone isn't enough to ensure extraordinary returns. Discipline is essential. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.